To this episode of Living the Working Abroad show. I've got the wrong glasses on today, so bear with me while we go through this story. And I want to start off by asking a question. Who does the bell toll for? Now the question, when asked like that, is often to say, well, we're all part of mankind. We've all got a part to play in this world. So that when something goes wrong, when a rock falls in the sea, when someone gets sick, when somebody has an element of misfortune, and we say a prayer for them, the bell tolls for that person, but it actually tolls for ourselves, because we're all part of the same world, we're all part of the same humanity. And I'm going to just set up my screen so you can see a bit more of the logo in the screen. Who does the bell toll for? It tolls for thee. There's tax changes coming up in the UK following a recent election. Change is constant. We've seen that over the centuries, over the years, and nothing's going to change. So in the Living and Working Abroad show, what we're trying to do is look forward for people to look at what the tax creep is going to be. After election, the new government has got a 5-year window in the UK to make a difference. And if they want to reset their foundations, if they want to make changes over 5 years, they need to make them quick. And to make the changes that they want, if they want to nationalise rail services, nationalise power generation, and pay people in public service more money, they need that revenue. So the only revenue source that a government has got is taxable income, or they borrow. If they borrow money, they have to pay it back. We've seen all sorts of shenanigans go on with the UK over the last few years. Government debt is at a high. That's not the last government's fault, it's every government's fault, one after another, borrowing money to pay back tomorrow. So the government has interest to pay to the international money markets, and that money that they pay back with interest comes from taxation. So this is where we are, and we need to find out how the tax creep is going to affect us in the coming months and years. One of the big issues for people in the UK is inheritance tax. Inheritance tax is a capital gains tax, okay, and it's based upon your domicile and where you're from. So consider that and consider what your options are, because inheritance tax is paid when you die. So when the bell is tolling, your family are paying the inheritance tax. So how about sorting it out now? But it's not as simple as it looks. And at the end of this webinar, if you hopefully you listen to all of it, but if you certainly listen to the end, we'll talk about a way that you can change your domicile by changing your citizenship. It takes time, it's not simple. I'll explain more. And it's all part of living and working abroad. It's all part of the advice and the guidance we give to people that relocate overseas, invest offshore, and develop a lifestyle in another country, living and working abroad. For more information and guidance, contact us at proactpartnership.com. Inheritance tax is paid, it's a capital gains tax, and it's paid on death, and it's based and assessed on your domicile. So it's part of the capital gains structure, which is under scrutiny and potential threat for tax changes by the new UK government. If they change, at the moment we've got capital gains tax in the UK ranging from 10 to 20% for investments and 18 to 24% for property. Why not align that with income taxes at 20 and 40%? Inheritance tax, a capital gains tax on your estate, on your life, is already 40%. So it would be a natural argument to say, we're simplifying things, we're bringing it all together. And that's what could end up doing. Capital gains tax was introduced in 1964, so 60 years ago, and now capital gains tax has come of age. The Labour Party introduced it in 1964 as a tax on wealth, a tax on capital. Whether that capital is earned or inherited, it is a moot point. But if you've accumulated wealth in property, investments, in business, or in savings, that is now subject to a capital gains tax. And the revisions could come, and they could come this year, to simplify and integrate finally, after 60 years, into pensionable age. Capital gains tax will come of age and become a tax possibly aligned with income tax, but on any capital. How would that work? If you are a crypto investor or a share investor, and you invest £1,000 in shares and it goes up to 5,000, you sell that, you've got a capital gain. Now, in the past, you would have a personal allowance on capital gains. You could earn as much as 12,000 a year, similar to the personal allowance for income. So there's a personal allowance for income, 12.5, personal allowance for capital gains, almost 12.5 at one point. That personal allowance for capital gains has been reduced dramatically down to £1,500 is the level that you're getting for dividend and capital gains tax relief at the moment. Why not abolish that altogether? So you've got one personal allowance, and so if you get a capital gain of 4,000, there's no personal allowance against that. It's all taxed as a capital gain. But also, if they align the capital gains tax law with your income tax, so you earn £20,000, you're paying 20% tax. You earn another 4,000 profit on your crypto capital gains sale for 5,000. Take away your one for the cost, the gain is 4, so that adds 4,000 to your income, which at 20% tax is another £800 tax. So that is a very, very simple method that could work and simplify the UK taxation and double the rate of crypto tax, which at the moment is taxed as an income, a capital gain at 10%, to the basic rate level of 20%. Of course, if you're a high rate taxpayer, you're paying 40%, so that the 4,000 gain would then be charged, and you get £1,600 tax on that gain. So suddenly the numbers are starting to add up. Already we have property capital gains at 18 and 24% for basic and high rate taxpayers. So to simplify it, remove the personal allowance for capital gains and make the capital gains tax rate exactly the same. Could be a very profitable way for the government to go to tax your capital assets. And if you've got that money in shares, in crypto, in property investments, it's already there, it's already registered. They've got your tax number as a beneficial owner of that registration. The OECD changes of tax rules over the last few years have required any property rental agent, any mortgage company, any investment company, any bank, any crypto dealer, anybody that's dealing in money and finance and wealth, to understand what your tax number is, your identity is, and where you are. So they can link all these things together and assess your income and your tax. So this is the world that we're going forward for. And as a domiciled UK resident on death, inheritance tax of 40% is unavoidable as well. But by bringing capital gains levels up to 20 and 40%, it's aligning it with inheritance tax and potentially, simplifying the rules. So we're building a foundation, we're simplifying the system. This is the PR playbook that will already been prepared by the Labour Party. We saw in the Garden Party a couple of weeks ago where the standard. Oh, it's worse than we think. Oh, it's going to be painful. Oh, we've got to put up taxes. So here is one way that they can do. So anybody with shares, capital, property, investments, or any sort of wealth who's going to die anytime in the next 60 years is going to potentially get some form of capital gain, either when they sell that asset or when they die, inheritance tax is paid. Have in mind that at the moment we have these pension funds and we've got this bit of a pension crisis. So again, the rules have changed a lot over the last 30 years. Let's look how pension rules have changed. You used to be able to get tax relief on all the money you put into a pension scheme. That's gradually been whittled away, limited, reduced to basic rates. And then, but the idea was it would grow tax-free and then be distributed as taxable income. But now that growth is taxed as well. It's been taxed for a number of years. So the growth of pension funds isn't quite what it was because the government had taken their tax from that. So it's tax-free when it gets in to a degree, taxable as a pension fund, and then it's taxed when it comes out. So it's a double whammy. But sometimes, depending upon the outcome of the family arrangements and the pension benefits, whether it's defined pension or self-invested scheme, that there's a fund at the end, and it could be tax-free for the beneficiaries, or it could be taxed at up to 45-50%. So why not make a pension fund subject to inheritance tax as well? If a pension fund provides for a main earner for his family and his partner, and he dies, does the family need to have the whole income? Why can't the government have half that capital, half that income as tax now, and the family stay in their place, on a lower income? And why should the children of the person with the pension fund benefit from that pension? Why shouldn't the state benefit from it and allow more people to save more money and pay more taxes to earn their own pension fund during their working lifetime? So potentially, when we're talking about capital gains and inheritance taxes, why not extend it as a threat to all pension funds as well? Now, pensions are taxed in the UK under separate rules, so getting that money away from the UK is even more difficult. You can, if you become an expat living and working abroad, move your pension overseas, and you've still got some tax liability somewhere, but there is a potential for you to avoid any future increases or capital gains or inheritance taxes if they're introduced on pension funds going forward. So we are advising expats living and working abroad how to take care of family, property and business across border and down generations. It's on edge time. We see political tensions around the world, in Europe, outside Europe, and across the world. We've still got some big elections to come this year, the biggest being the American election, and we're looking forward to do that. But what we're seeing in 2024 is a picture of what was envisaged for 1984 when George Orwell wrote his book in 1948, that because the government have got information online and they're learning to use that information online in the same way that the media companies use your data for their business benefit, the governments now are able to use the tax, the ID, the verification data, the biometrics are in your passport and your ID cards linked to your property rental agent, your bank cards, your investments. They're able to use all that information to know where you are and what you're doing and how much they can tax you. And that, at some point, is it a democracy or is it an autocratic government? A democracy is about having the freedom of speech, the freedom to make decisions, the freedom to live your life in the way that you want. When that becomes the state looking after people or the state running services, it becomes a blurred vision, which is what we've got in Europe over the last 100 years. But when we've got a government in the UK with an absolute majority, they can then decide what is best for them, and as they know better, they can make a judgment on what's best for other people, because they are more equal. They've got the power, they can change the laws and they can adapt the rules for what they think is best for everybody else. So some people are more equal than others, and the big brother elite, metropolitan elite, will decide for you. And therein we get an autocratic democracy, not an autocratic dictatorship, but an autocratic diktat under the guise of democracy, where effectively there's no opposition to the people in power and control. One circumstance of this is if you want to buy, this is bizarre, if you want to buy a petrol car in the UK, you might have a waiting list of a waiting time of 6 to 8 months at the moment. Now, is that because the motor manufacturers are not producing enough cars? No, it's because they're not selling enough electric cars. The governments around the world chasing down net zero as soon as possible, just because the world's climate might change. It may or may not. I'm not a climate expert, but I know we've had ice ages in the past and tropical periods in the past, and they're likely to repeat. The world will sort it out for me. But what the governments are doing is chasing towards net zero. So in the UK at the moment, the car dealers, the car manufacturers have to sell a certain quota, a certain proportion of electric cars to petrol cars. Because petrol car sales are outselling electric cars, you can't buy a petrol car at the moment in the UK because they can't sell it. They can't sell it until they've sold some more electric cars. And that means if you go with the cash to buy a car today that's on the forecourt, you can't buy that car for 6, 8, 9 months because of the quotas for electric cars. Now, electric car might do the job. I've always wanted a Tesla. I don't have a Tesla at the moment. I also don't have 100,000 to spend on a Tesla at the moment. I've got better things to do with it, and I wouldn't necessarily want to spend 100,000 on a depreciating asset like a car. But we now, through the autocratic democracy that we live in, enforcing net zero targets, you have to wait in line for the ration of a petrol or diesel car, unless you want to buy an electric car now. Another way that drivers might be attacked in the UK's forthcoming tax, another way that UK taxpayers and motorists might be attacked in the upcoming changes to taxation in Labour's first budget in October 24 could be a toll. So we said at the start of this presentation today, who does the bell toll for? It could well toll for thee. For those of you that ever went to Wales on the new bridge that they built between Bristol and Newport about 10-15 years ago, there was a toll on that bridge for many years that was lifted a couple of years ago because the toll only paid for a certain period of time, and that period of time was designed just to cover the cost of building the bridge. So now people can freely pass from the UK to the land of their brothers in Wales. However, there's other private road schemes which are done at a very limited basis, north of Birmingham, for example, where they've introduced a toll road. So if you want to take this quicker, direct motorway, you have to switch onto that and pay the toll for during the journey. So toll bridges in Wales were slow because everybody had to stop on the motorway to pay at the toll, either cash or with your card, to go through the toll bridge. But of course, a government doesn't need to do that anymore. It's got the technology because it's been smart, it's updated the motorway, and now they've got cameras. They check if you're speeding, they can see your number plate, they can see your face, they can see your facial recognition. And if your car is registered to you as an individual at your address and linked to your payment systems, or not, as the case may be, why not charge you a toll? Why not make roads a toll? And why not introduce it a little bit and then let that tax creep to extend it to everybody else? So toll bridges, toll roads are something that have been in existence for hundreds of years. So why not bring that forward? Why not make the motorists pay? If you want to drive from A to B because you have to go to work, or you have to go and see your family in hospital, or you have to go and attend your son's graduation in the next county, why not make those people pay an extra tax, a toll per mile for their driving? And that would be very easy to collect by having toll roads, using the existing car technology, the camera technology, to click the driver plate number so that that car pays a toll per mile. And if every car in the UK does 1,000 miles a year, that could generate a lot of revenue, even at a penny per mile for the government, as a way of increasing the cost. Again, it's a simple way that they could use technology to generate additional tax and additional revenue, and they would sell it under, let's reduce global warming by reducing the amount of people that travel and how they travel. And it might well encourage car sharing, remote work, not bothering to go and see people or turn up and meet people face to face, just to stay at home. But we'll see. It's a potential tax that could be charged going forward. Many of our clients who are expats living and working abroad have still got property investment back in the UK. So property investment has been a big source of growth over the last few years, as private landlords have used the property as investment to generate investment income. Now, whether that's a good thing or a bad thing is immaterial, but it is well taxed. All that property rental income is subject to income tax. So if you're paying 20% income tax on a 40,000 salary and you get another 20,000 for property rental, then it takes you into a higher rate taxpayer. So not only are you paying your 20% as a basic rate taxpayer, you're taking you into the 40% tax rate. So that's good for the environment and for the economy, good for the tax environment in the UK. However, if you want to raise taxes, if you want to make everybody more equal, and not allow these landlords with this investment income to be coming in and not tax too much, then you do two things. First of all, you adjust the capital gains tax rate. So it's already higher for property than it is for investments at 18 and 24%. So you could adjust the capital gains to 20 or 40% based upon income or high, basic or high rate income tax. So that would be one way to improve the tax take from property rental income. You could also consider removing the personal allowance against property rental income. So at the moment, the personal allowance is for income, which includes property rental income as a business source. So they could do one of two things. They could say, well, no, it's not an income source, it's a special investment source. So like dividends and capital gains, it has its own tax regime, and it's just going to be taxed without the personal allowance. The personal allowance is for earned income only, is what they could say. The other thing to say, well, if it is earned income, then it should be subject to national insurance. Now, there's a quirky issue there. So national insurance, social insurance, is supposed to be to contribute towards benefits and state healthcare and state pensions. If you're a pensioner with investment property, where's the fairness in paying the national insurance? Or is it that the national insurance is actually just seen as an extra tax by the government that's completely in debt with loads of government borrowing and interest to pay? So they're funding pensions, they're funding state benefits out of taxation currently without the reserves. So let's just remove the charade and treat national insurance as a tax, extend it to property rental income as well. And that would make a change. And again, the political sales playbook is already set out that, this will reduce the number of private landlords, make more affordable homes available for working people. As the case may be, we will see. But landlords, private landlords, could be potentially attacked with that. Now, there's lots of ways to manage that. One way would be to incorporate and set up your own property business. Again, this might come up to certain different taxes, but essentially corporation tax and the corporation tax regime is similar to income tax, and it can be more controlled, but certainly it can protect you from national insurances. So that would be a way of protecting that. Another way would be to use a family trust to protect your assets. So whether you've got property, business shares, investment shares, or other assets, using a family trust can protect the assets from dividend or inheritance or income taxes across the board and down generations. So for more information and guidance to protecting your property asset, contact us at proactpartnership.com. The other couple of things that landlords get is that you've got the local tax rates. Now, local tax rates are a weird and wonderful thing, but they pay for local municipal expenses. So that principle is probably not going to be removed. However, what has changed over the last few years is that private landlords or second homeowners can be charged a different local rate. So the locals can pay 100% of the communal fees to the local council, and it could be that they could be charged 200%, 300%, 400%. So what rate or what special taxes for let property or second home property could be extended throughout the country. So it's not just second homes that could potentially be charged a higher council tax rate, that the council tax rate for private rented properties could be increased as well. So these are things that property landlords need to look out for. And not every method will protect you from that, but there are some potential steps that you could take. Going back to whom the bell tolls for, inheritance tax is a 40% capital gains tax on death. Now, let's assume that rate doesn't change, it doesn't go to the additional tax rate of 45%, or capital gains taxes are raised to a higher level altogether. Your domicile of origin is where you're born and where your parents are from. So an expat could be born in one country, but their domicile is another country based upon where their parents are from. So if UK parents are living in the Middle East, in Dubai, and they have a child, because of their British citizenship, that child can claim at age 18 to be domiciled to the UK. If that child spends the whole of their childhood at age 18, they could choose a domicile for Dubai because they've lived and worked abroad had their whole life and their whole family experience living and working abroad, and therefore potentially change their domicile because of that. So there's an interesting scenario, but that's what it takes. If an expat comes to the UK at the moment, after 15 years of being in the UK as a tax resident, you're deemed domiciled to the UK. So that makes you open to capital gains tax, inheritance tax, and dividend taxes and income taxes on your worldwide income. And the hole has already been plugged in a way in that they've asserted that anybody who's non-doms to the UK, the rules are going to be changed anyway, so that their current remittance basis for taxation of expats in the UK of dividends or income or interest is going to be removed, and it will be taxable if they are tax resident in the UK in that year from year one. So your tax residence for the year becomes effectively the same as your current domicile for dividend inheritance taxes. But what if it affects your inheritance tax liability as well? That's about your domicile of origin or your domicile of choice. So at the moment, 15 years is what HMRC deem you to be domiciled in the UK. Could that be reduced? Could it be reduced to 4 years, to 10 years, or to 1 year? We're worried to see. Actually, it wouldn't be 1 year. We shouldn't have said that, but there's certainly at the moment with capital gains that there's this 5-year window of looking to get a tax exemption on a capital gain if you're living and working abroad. So it could be like this 5, 6, 7 years could be deemed to be the time that if somebody's lived in a country for that long, it lived in the UK for 5, 6, 7 years, as a tax resident, then you become domiciled there as well, and therefore liable for the full weight of UK taxes on your worldwide income and capital. Again, we'll see what changes are introduced in the budget, the painful budget of October 24 by the new autocratic, democratic government. We will see. How can you change your domicile? You can choose another domicile, and it's hard. And to get an inheritance tax assessment in the UK, you need to die. You're not going to get an inheritance tax assessment before that, so it's quite difficult. I'm not saying it's impossible. I'm saying there are things to do. So, first of all, if a family gifts into a trust, then the trust that they're creating is potentially exempt from capital gains tax on the gift. It could be a family gift now, so it's free of inheritance tax straight away, or it could be a potentially exempt gift as well. So a trust is a way of gifting that asset away. It could lose some control for the person giving, but also save some tax. And what I always say is that you don't need to own the Ferrari to enjoy driving it. You can go and hire the Ferrari for a week and enjoy the drive without being the owner. You can live in the house as a renter without owning it to enjoy living in that palace. So a trust allows a family to own assets indirectly for the benefit, the investments in that family trust are for the family's benefit and for nobody else's. But the assets are not taxed on the individuals either during their lifetime or on death. They're still going to be taxed, but what becomes the tax regime? So when you look at a country like Cyprus, you've got no inheritance tax and no capital gains tax on investments. Effectively, the only capital gains tax that exists is if you own Cyprus real estate. So you've got real estate around the world. It might be taxed in the country where it's fixed, there's a fixed asset, but there's no additional tax in Cyprus for Cyprus tax residents. If you're not a Cyprus tax resident and you want to be one, there's a couple of ways to do it. One is to set up a Cyprus family trust where you could be tax resident in another country, but the family trust can be tax resident in Cyprus and enjoy the inheritance and capital gains tax benefits of holding those assets in that Cyprus family trust. The second way would be to consider relocating to Cyprus as an expat and eventually getting citizenship. Now, gaining citizenship in a different country is quite an interesting and challenging situation, and generally it's about time that you spend living in that country. Now, some countries have longer time spans where you need to be in the country, up to 10 years. Other countries like the UK and Ireland, you can get changed citizenship after 5 years. Cyprus has always been a bit longer, but this year they've changed the rules, and with a couple of conditions you can actually get citizenship after as little as 4 years. So in the right scenario, if you just lived in Cyprus for 4 years, with no more than a short stay, 90-day out of the country each year, and you've been continuously in the country for the last 12 months, then after that 4-year period, you could apply for Cyprus citizenship. So 4 years is very, very competitive for an expat that wants to consider changing their citizenship or getting a dual citizenship or getting an EU citizenship where there's no family or historic connections with that country. An expat can come and live in Cyprus and pay 0% tax on dividends, 0% tax on interest, 0 capital gains tax on investments other than Cyprus property, Cyprus real estate, and 0 inheritance tax. You do pay 5% tax on pensions, and you do pay income tax up to 35%. And there is a health tax, which is like a wealth tax of 2.65% on your worldwide income. But still, overall, the burden is designed to be much less on your income and on your capital going forward. So fast tracking into Cyprus to get Cyprus citizenship, once you've got that Cyprus citizenship and you've lived in Cyprus and you've applied for dual citizenship, that's real evidence to support your claim that you're no longer domiciled in the UK, that you don't see yourself coming from the UK, that you don't want to have any association with that country. So those are the things that we need to consider and look at to get away from UK inheritance tax in the long run. Gifting into a family Cyprus trust or taking Cyprus citizenship. So going back to Cyprus citizenship, the new rules. So the key point is that they're bringing in a requirement where you have to have some Greek language skills by examination. So you have to demonstrate that, not just that you know the history and the culture of Cyprus, which has always been the case in a verbal examination with the citizenship officials, but you have to show that you understand the Cyprus culture and history, but also you have to have a Greek language exam. Now, officially, the languages in Cyprus are Greek and Turkish, but the only for the fast track citizenship in the Greek Cypriot Republic, it's only requiring a Greek language proficiency. Now, depending upon what EU level you want, B1 or A1 would depend upon how quickly you can get that citizenship and you can get moved over into that arrangement. So you can get that. You can get it after 7 years, as long as you've lived in the country for 1 year and you've been a tax resident for 7 out of 10 years, for 2,555 days in fact, and you've got a basic level of Greek language exam, you can get citizenship. But if you've got a higher level of examination status, after four years with sufficient income, around €2,500 a month, you can get citizenship in the UK as well. So it's a big opportunity, a big way to get a dual citizenship, a new passport, throw away your old passport and claim to be domiciled in Cyprus and pay 0% inheritance tax, 0% capital gains, and 0% dividend tax as an expat for up to 15 years. For more information and guidance on protecting your family's wealth from inheritance and capital gains taxes and changes in the UK, you can contact us at proactpartnership.com. Thanks a lot for listening, and we'll see you again next time.